part three, risk management, in a moment. I do want to just remind, got a lot of questions here on this chart on page 406. Mark will go over anything that you need to be reviewed tomorrow during the live trading day. This is part, I will also just really quickly share the compounding is a positive once you are a profitable trader, is what the concept was. If you're not a profitable trader, compounding works against you. But once you do reach a level of competency that you are a profitable trader, then that's where Mark said you must compound your returns in order to achieve true wealth. So hopefully that will be uh, understood. That the But tomorrow, Mark will have time. He can go through that chart, not a problem. Just type a question in that you have with relationship to it. And any questions you are typing in the chat room, again, as a reminder, please put the page number down first and then your question so they can be organized properly for Mark. We are going to start here with the next session, which is part three of risk management. This will last about 45 minutes as well. We'll have a 5-minute break there before we then conclude with section 4. All right, let me just clarify myself before I make things even worse here. Mark is saying you always have to be compounding. You always want to be compounding. But I'm going to make sure that he goes through that real quick tomorrow as well, just to clarify, because there were a bunch of people typing questions in.
How about if I go through it right now?
All right, even better, even better.
I can see how this is going to turn into a disaster in about 5 seconds. All right, listen. This compounding versus non-compounding chart, it's not like, one is better than the other under some different circumstance. If just forget about that. All right, you're never going to look to not compound. You're always going to be compounding. It's just making a point. It's just an example to make a point that numbers, if you don't clearly understand them, they can fool you. They can be very tricky. All right. So you have to make sure you clearly understand them. Keep it very simple. I'm showing you the very simple way to do this. Now, if you weren't compounding, well, if you lost 50% of your money, how would you add back to start over? Let's say $100,000 and you lost a 40 or 50% of it. Well, in order to not compound, you'd have to add $50,000 back. You'd have to constantly be going and getting more money. So obviously that's not realistic, right? Let's just say you only had $100,000. Well, how would you add money to it if you lost 50%? So just forget about the either or scenario. It's just to make a point. That's all it is. I wish I never put it in my book, I have to tell you, because it's completely misunderstood. But that's one of the reasons why I'm showing it here. So let's move on and let's just move on from that. Okay.
All right, page 407 in your workbook, part three, risk management, part three. This again will last about 45 minutes.
Okay, we're back. We're on risk management, part three. We've discussed risk management in 2 previous sessions, and we're going to continue. This is the final section of risk management. So we're going to talk about a few other ways to mitigate risk and risky situations. The first is going through earnings, holding into earnings. So it could be very risky going into earnings, holding into an earnings report. You don't know what to expect. Earnings are released sometimes after the close or before the open. First of all, I tend to favor holding a stock into earnings when they're released after the close. Now, if they're bad, that overnight could end up exacerbating that. But I like to give the stock time to be able to digest that. And after the close allows a bit more time. However, I'm not going to let that deter me from holding into earnings. I'm going to hold into earnings usually if I have a cushion in the stock. And similar to like progressive exposure, if things are working really well, I'm going to hold to earnings more often. And if earnings reports have been beating expectations, and a lot of my stocks have done well with the earnings releases, you'll see there's trends in these things. Sometimes you'll find that just everything's blowing up on earnings, and other times you have where it's a great market and every stock's popping on earnings. This is something you have to sort of gauge. But if you're going to hold to earnings, one of the best ways to do it is to have some type of cushion. So if the stock does come in, um, you're at least not giving up either your principal or a good portion of it, and you've got some type of profit cushion. The same theme that I've been talking to you about over and over: financing risk, letting your profits finance the risk. Not that you get careless with profits and you start regarding them as house money. Once you have a profit, I regard that as my money, and I'm protecting it with the same set of rules that I protect my principal. However, to protect yourself from drawdowns, you want to let your profits finance your risk. And so, very simply, if I have a profit cushion of 8 or 9 or 10% in a stock, I can hold the stock even if I think the stock's going to be volatile and maybe come in 10 or 15% on a bad earnings report, because that's going to cushion the majority of that blow. And just taking a look right here, this is just an example of a stock that came out of this base. And so I guess some of the questions that I've gotten over the years is, so do you trade right before an earnings report? What if it comes out of the base? Like in this instance, you come out 1, 2, 3 days just before an earnings report. So would you buy a stock, that close to an earnings report? Yeah, very often I will, because this is the type of situation that will happen. You'll get the stock will break out of a base, it'll run up for a few days, and you'll be at a profit cushion that you can then hold through the earnings. Sometimes I'll buy the day before an earnings report to see if it'll pop, and if it doesn't give me a cushion, I just get out of it. So in this case, you broke out, you came up for a few days, you had a profit cushion of 8%. Stock gets hit, and you can see it comes back down, but doesn't hit the stop. And sometimes you'll get cracked hard on a report. But if you have a cushion, it'll come back in, it'll come back to your breakout, maybe undercut your breakout, won't hit your stop, and then over subsequent days or weeks, it'll regain and then move higher, and you'll still be in the trade. Let's take a look at another one. So 6% cushion here. This is the one that did not come back, but you can see, again, buying it coming out here, little VCP. Stock comes in before the earnings, doesn't hit the stop, runs up a bit. You have a little bit of a cushion, you hold through the earnings, and now, of course, you just get stopped out after post earnings. Another one here, this is one that TRN, I actually bought this right here, and it had a nice little cushion before earnings, and earnings it popped real nicely. You can see that, and then had some post earnings drift after that. So again, you want to give a chance. You want to put yourself in a position to be able to hold to an earnings report, because especially if it's a high growth company and they're reporting great earnings, market is acting well. You want to be in those better names that have those big earnings and give the stock a chance, because that's where you're going to get a big pop on the stock. You might hold the stock and get a decent gain, but an earnings report can really pop the stock. It could also drop the stock. So to get an idea, or a decent idea of how much the stock might move against you or in your favor, there's a way that you can do that using options volatility. I'll show you a little trick here. And again, this isn't perfect, but it's going to give you a good idea of the type of move that you're going to expect on the stock. Now, the problem is not all stocks have options. So you can't do this on every stock unless it has options. So it's a very simple formula. There's a more complex formula too. We can probably show you that or explain that to you another time. But this is the easiest way to do it, and it's close enough. It's going to get you really close to the number that the more complex formula would get you. So you take you find the closest strike price to your price of the stock, where your stock is trading. So in this particular instance, we've got a stock price of $162. So in this hypothetical example, the closest strike price is 160. So we find that strike price, and then we take the calls and the puts, and we add the ask prices. So in this case, you have 350 and 275. You add those together, and you get yourself 625, right? You divide that by the stock price, and that gives you a number. You move the decimal over, or you can times it by 100, and that's going to give you a percentage. So in this case, 3.86%. That's the amount that the options market is pricing in either direction. So this stock is essentially going to go up 4% or drop 4% on the earnings. You'd be surprised how often that this formula is very close to being correct. I mean, sometimes you might say 10 or 12% and it moves 15, but it'll give you an idea. So we use this all the time. We constantly, when we're going to go into earnings, I always ask my assistant what, to calculate this and let me know what the options are pricing in. And from there, I'll make my decision whether I'm going to hold into earnings. Now, another tool you can use, holding into earnings, or even if you just want to try to, you're onto a stock that you really want to make sure that you stay in at least a piece of it because you feel like it might be a key leader. Maybe you're starting a new bull market, and you want to make sure that you don't, let go of stock. Like you might have a tiger by the tail and you don't want to let it go, right? So you want to always operate within math that makes sense. We talked about mathematical, making mathematical sense. You're not going to, be right 50% of the time and have an average gain of 8% and take 8% losses, right? You would lose money. So it has to make mathematical sense. Well, you can use what I call staggered stops and still make mathematical sense, but use a stop on part of it that's larger than maybe your maximum stop. So let's just say your maximum stop is 8%. That's the most that you want to risk on any trade. So if you set a 6% stop on half the trade and a 10% stop on the other half, you end up with an 8% loss. If you get stopped out of both of those halves of the trade, you end up with that same 8%. The only difference is that you choke off half of it by 2%, but you also give half of it an extra 2%. Now this could very easily be 4 and 12, and you'd give it even more room, but you'd have more likelihood that you would choke it off on half of it. So you can come up with any numbers. You can use as many stops as you want, but the point is that you're going to give it a little extra room. All right. And it's better to be in half the position than no position if the stock's going to come down, stop you out, and then move up and double and triple. So this is one way you can do that. Of course, if you had a 4 and an 8, it would give you a 6% loss overall. Now, as far as stop placement, people ask, where do I place my stop? So I try to back into a trade with the tightest stop possible. Generally speaking, the tightest stop that I'm usually setting is 2 or 3%, 3% or less. But I would say, 2% to 3% is super tight. On average, I'm setting stops 4 to 6% on average, and my maximum stop is going to be 7 or 8%. And then what I call the uncle point is the 10 to 12% mark. That's where if I'm using a staggered stop, I might use a 10 or even a 12 and use that with a 4 or a 6 to end up with that maximum stop, but giving it extra room, like I just said. So that's really my stop placement in a nutshell. It's either going to be based on a technical level, like we talked about before, or it's going to be a mathematical stop. And even if it is a technical stop, I'm always backing into the math. So it would have to make sense mathematically. I'm not going to say, well, the stock is, breaks down technically at 20%. That's too large. So I wouldn't be able to justify that. Let me show you how this looks. So this was a stock that I actually traded, ISIS. You can see breaks out here and comes back in, and this stock comes in a little over 6%. So had you had a 6% stop, you'd have got knocked out of all of it, and then a few days later, boom, off to the races, right? If you used a 4 and an 8, right, you would have gotten stopped out of half of it, but you'd still be in half. And then when this turns up so nicely here, this actually just pulled back very orderly to the breakout point. Yeah, you probably could have added it back there. I think I actually added some shares on there. I think that's how this worked. I don't remember it exactly, but I remember I did add some shares on this breakout here. So again, this will keep you in half the trade. Now you can do this with thirds. You can do this with quarters. However you want to slice it and dice it, you can do it. As long as when you come with all those numbers, all those stops get hit, when you average it all out, that your overall loss makes mathematical sense. It's still within that range. So now another thing I want to talk about, we previously talked about violations And if you remember, David Ryan said, when we make these 3 lower lows, we talked about 3 or 4 lower lows. And right after the breakout, how important the 20-day, the 50-day is, the 3 lower lows, the high volume or low volume out, high volume in is a violation. Well, again, if your stock, you set a stop, maybe 6-8%, and it comes in on a few lower lows, 3 lower lows, but they're not very big. It's not much volume. The moving averages are very tight to the breakout point. You probably don't want to just sell because of that. That stock isn't really acting that abnormal just because it's trading near or below those moving averages and have a few lower lows. So in this particular instance, you're down 4.25%. This stock trades down 4.25%. I generally don't set a 4% stop, but sometimes I will. You would have been knocked out, of course, if you use a stagger stop. You'd be in half of it, right? If you would use a 4 and a 6 or a 4 and an 8. The key is that you don't want to choke off a trade. When we start talking about risk and we get into risk management, people start getting crazy and they want it. Now they say, well, I'm just going to sell it if it goes down, 1%. Why would I take any more risk? I want to keep my loss as small as possible. Well, if you choke it off and you trade with too tight of a stop, you'll be stopped out all the time. You'll never give the stock a chance to actually make a move and have some fluctuation. Stocks have to fluctuate a little bit. So again, you're anywhere between 3 or 4% and as much as 8%, 10% maybe if you're using a staggered stop. But once you get a little tighter than that, that now you're going to be doing a lot more trading. And that's what you want to do, fine. But try not to choke off the trade. Even if you have, some of these lower lows and you get a few violations, if you're still within that stop and it's not too large, you're down 2 or 3%, you usually want to stick with the original stop. So here's Yelp, right? Comes out of this little cheat area right here, moves up for a few days, 1, 2, 3 out of 4 days, and then pulls back 1, 2, 3 lower lows. So there's a few things about this that makes me not sell here. One is that third lower low, as I pointed out earlier, when you get a third or a fourth lower low, you want to see if you can get some accumulation there, if you can get some support on those lower lows, on that third, that fourth lower low. And then if you can, which you can see here, you had a third lower low, but then it traded all the way up and had a nice close. So I'm going to give that the next day or two and see if that can come back and give me a little pullback buy there. And sure enough, the next day it stabilizes and then wham, right? You see the tennis ball action. So you had 3 lower lows, but the stock was only down 3.5%. It wasn't down really a large amount. It didn't really break down technically, and you had some supportive action there. So again, I'm just trying to show you how to balance between risk management and choking off the trade and being too tight on the trade. All right, so that's one area of risk that we discussed: holding into earnings, and also giving the stock some fluctuation, not choking off the trade. What I want to talk about now is something that really is a topic that a lot of people have a lot of questions on and seems to be for some reason, a confusing subject for a lot of people over the years that I found, and that's position sizing. Now, a big part of position sizing is personal, and it depends on your risk tolerance, but it also depends on math. Right? There's an optimal position size. If you know your batting average and you know your average gain loss, then it becomes a mathematical equation. You can use formulas like optimal F or the Kelly formula. You can look these up and see how you would optimize your position sizing, knowing the information that I just said. And if you have that data and you know your average gain, your average loss, your batting average, and you have this data, then you can optimize. Now, if you're a 2-to-1 trader, and let's just say your average gain is 12%, your average loss is 5 or 6, you're right about 50% of the time, the optimal position size is 25%. That's your optimum position size. Now, and that's why I shoot for my biggest position sizes for 25%, because that is my optimal position size for a 2-to-1 trader, and I'm a 2-to-1 trader on average. So, but the way that you're going to calculate position sizing and risk is very simple. You're going to use one number, and that number and is a risk of total equity. That number is a risk of total equity. And you don't want to risk more than 1.25% of total equity. If you're really, really, experienced at this and things are working well, you can move up to maybe 2.5%. That's the most ever. If you move higher than that, your risk of ruin really accelerates. Every quarter or half percent more than that exponentially increases your risk of ruin. And that just means that if you had a losing streak, you can blow your account up. If you're risking 5% of total equity and you have a losing streak, you can take a huge drawdown and have a big debt in your portfolio. At 1.25%, that's enough risk where you're taking enough risk, but not too little. Now, you don't want that. If that number is 0.25, then you're not taking enough risk, and you're not going to make any money. You're not going to make any profits. So there has to be an optimal level. That optimal level is about a percent to a percent and a quarter. Now, with that, you're going to back into that number. Your absolute maximum stop on any trade should be no more than 8 to 10% for two reasons. One, like I told you before, the math. Once you start getting, 10% loss needs an 11% gain to break even. So the math starts working against you. Okay, that's the first reason, is purely from a mathematical standpoint. The second reason is that if you're buying correctly and you're buying at these proper buy points and you're using progressive exposure, you're not getting a very aggressive until things are working. So you're now trading aggressively in a decent market. 8% is all you need. You should know that you're right or wrong within 8%. You don't need any more than that. You probably need less than that, actually. On average, 5 or 6%. So that's going to be the maximum that you're going to need to know if you're wrong, if you're backing into these trades. We not only have I traded for 37 years, and of course, David Ryan's been trading even longer than me, and so forth. And whether we can go to, William O'Neill and other traders that have even traded longer than us. We also look back and looked at these chart patterns and these mathematics all the way back 100 years of trading history and found that this number is consistent all the way through time, that this is the number that makes mathematical sense for a maximum. Remember, a maximum loss. We're not talking about that this is every trade. Your average should be smaller. You're going to get stopped out. There's going to be stocks that hit a bunch of violations, and you make a decision to get out of them before it even hits your stop. It might be down only 2%. And then there's going to be stocks that you trade that come back to your break-even point, and there's a little bit of slippage, and maybe you get out down 1 or 2%. So you're not going to have, your loss isn't going to be 8% on average. It's going to be smaller than that, and it should average somewhere around 5 or 6%, no more than 5 or 6%. If you're averaging 7 or 8, then you're letting a lot of stocks slip below 8%. That's, or you're cutting all your stops out at 8% at a hard level. So 5 or 6%. The other rule is, with position sizing, you really should never take more than, at an absolute maximum, be a 50% position size. When I was trading a small account, when I first started, was trading just a few $1,000s. Yeah, I put my whole account into one stock. And then when I had $30,000 or $40,000, I divvy it up into 4 stocks, 50% position, 4 stocks fully margined. Then when I got up to 100,000, a few 100,000, I was trading 4 stocks, 25%, 8 stocks margin. Now, there's no reason though to be, you could be trading a multi-million-dollar account and there's still no reason to go up and trade 20 stocks, 15, 20 stocks. You only need 8 or 12 stocks, and that's with partial positions. That's about all you need to get invested in the market, be in some of the better names. You might even have 15 or 16 names in a really good market when you've got partial positions. You sold half, you peeled off some, and you've added some new positions. You took a few pilot buys in the beginning that were smaller. Yeah, you might have a handful of names, but your bigger positions are going to be maybe 4 or 5 names that you have some really good sized positions in. So you want to shoot for an optimal 20 to 25% position sizes in your best ideas. When things are working, you want to shoot for 4 or 5 big positions, maybe 8 to 15 or 16 stocks maximum. If you're trading a much larger account, even if you were trading $10 million, I would say there's no reason to be above 10 or 15 stocks. Kenneth Hebner trades billions of dollars, and he Sometimes he only owns 10 names. He's trading very liquid names, but we're talking about billions. So I hear people say, oh, it's this stock's too thin, or I have to take a bunch of diversify, and they're trading a $200,000 portfolio. You're not trading, Fidelity fund. You're trading a small trading account. Excuse me. So let me show you how this works. So, and we have a piece of software that we can manipulate these numbers. Maybe during live trading, I'll bring that up and I'll show you how we can manipulate these numbers and then sort of see what needs to be accomplished to get to your goal. So let's just say your goal, your desired return in this particular case is 40%, and your position size is 10%, right? Your average gain is 12%, average loss is 6%, and your percentage of winning trades, your batting average, is 40%. So you're right 4 out of 10 times. You calculate that out, you're going to have to do 334 trades to get to that 40%. Now, the question is, how long is it going to take you to do 334 trades? That's, if it takes you 6 months, well, then you can get an annual return of almost 100%. If it's going to take you a year, then your annual return will be 40%. But you're going to need 334 trades, right? This isn't taking in account compounding. This is just straight using these numbers, straight math. So not taking into account compounding, you're going to need 334 trades. Now, let's bump that position size up, right? If you have an edge, moving your position size up is going to make you more money. Now, when things aren't working, you're going to lose more money. So it's a double-edged sword. However, all things being equal, if you have an edge, you move your position size from 10 to 25%, you're going to make more money because you're going to accomplish more in less trades. So that same 40%, when we move the position size up to 25%, right? We have the same numbers, exact same numbers, 12, 6, 40. Now we only need 134 trades to get to that same 40%. So now you're going to ask yourself how long it's going to take to do 134 trades. If we do the original this new number set with the 25% position size, if we do the 334 trades that we were going to do before, now we get 100% return. That same 334 trades gives us a 100% return. So you can see how this affects. Now, if you were to change your average gain, that would affect it too. You change your batting average, that's going to affect it too. You move your batting average up, the number of trades is going to go down. It's going to take you less trades to get to this number, this desired return, which means that you can fit in more trades and make a larger return in that same time frame. So it's all connected. This is all connected. So let me show you how it connects with risk and going back to that very important number, which is risk of total equity, right? Risk of total equity is the amount of risk you're taking to your whole portfolio. So if you have a $100,000 account and you want to take 1.25% risk of total equity, then you have to risk no more than $1,250. So here's how it works. Here's in real life with real math. If you were to risk that amount of money and you were taking a 12.5% position, you could take a 10% stop. 10% of the 12.5 is 1.25. If you took a 12.5% position with a 10% stop, you'd be risking 1.25% of equity. Now, you want to bump that up. You want to take a 25% position, right? So you bump it up. But what does that mean? 10% of 25 is 2.5. That would be a 2.5% risk of total equity. That's too high. Now, I told you that's the maximum. If you're really experienced, you can go as high as 2.5 in good markets when things are working. But I would recommend that you start off, especially if you're new at this, at 1.25. So at 1.25, if you're going to move to a 25% position, well, then you have to use a 5% stop. You've got to back into a trade that offers you an out or use a mathematical stop of 5%. You can't use a larger stop than that, or you're going to trade or a larger position than that because you're going to have a bigger risk than 1.25%. Let's bump it up again. Let's go to 50%. If you go to a 50% position, now to get that same 1.25% of total equity, you've got to use a stop of 2.5%. Now you're getting too tight, right? You're going to choke it off. So this gives you an idea of where you should be. And you can see that the stop and the position size as they move, one can affect the other because, or one, each one is going to affect the percentage of total equity. And that's the important number. The important number is the percentage of total equity. And like I said before, if this number is 0.25, it's too small. You want to optimally be around 1%. All right. So it's not that this is your max, even though it is your max, but it also is your optimal. This is where you want to try to be, whether you're using, whatever position sizing you're using. Now, that doesn't mean that you use a very small position and use a giant stop. Again, I'm going to go back here. We're on page 419. I'm going to go back to page 415 for a minute. Remember, all this is within the boundaries of 8 to 10% absolute maximum stop per trade. Okay, that's what you have to keep in mind. Maximum stop of 8 to 10%. So again, within those boundaries, you're going to then back into the 1.25%. All right, so with what you've learned so far, I want to ask a question and you can give the answer, of course, in your head, and then I'll tell you the answer. As a trader, which of these options are a better deal? A, $1,000 guaranteed. B, $1 million with a 1% chance of losing everything. So you think about that for a second. Think about what your answer is. Now, this isn't some test that is, you're brilliant if you come up with the answer. The reason for this is to illustrate a point. And that is, the key to this question is as a trader. If this is a one-time proposition, okay, if it's a one-time proposition, then the $1 million is the better deal. But as a trader, remember we said before, you're not going to make just one trade. You're going to make many trades, probably hundreds, thousands over time. So if that's the case, at some point, if you have a 1% chance of losing everything, at some point that 1% is going to rear its head and you're going to lose everything. It's a guarantee that you're going to lose everything. If you trade long enough with a 1% chance of losing everything, you're going to lose everything at some point. So the $1,000 is a better deal if you're a stock trader. So what does this mean? What does this really mean? What it means is you can never, ever afford to risk it all. You can never afford to take so much risk that it would cause you the damage that you couldn't recover from. That's why use a stop loss. That's why use correct position sizing. That's why you only risk a certain amount of total equity, because you're trying to keep yourself protected from a setback that would be so large that you wouldn't be able to recover from it, or it would take so long to recover from and so much work that it would defeat the whole purpose. You wouldn't be able to get a great return on your money. You don't want to be digging out of a hole. You don't want to be working so hard just to get break even. The goal is to make money and to compound it, right? You want to compound money, not mistakes. So this just illustrates that point and really kind of sums up everything that we've talked about in these 3 sessions on risk management. Let me point something else out about position sizing, because this is another thing that people really don't understand, and they're so in a hurry to get their money in the market and feel like they have to get fully invested or go on margin even. That's one of the most popular questions is, do you use margin? Do you use margin? Do you use margin? No, I don't use margin. And even when I don't need to use margin now, but when I did and I had a small account, even then I only used margin occasionally, very sparingly. My average exposure throughout any year in my very best years and my most aggressive times was 50%. So on average, I was in 50% cash. Now, let me explain to you exactly why that is and why it's not that important to ramp up your exposure too quickly, and that's why progressive exposure makes a lot of sense. So this is going to look kind of crazy. I probably could have made a better example, but this is the best way that I've come up with to show it. But each one of these little dots represents a trade, and the dark dots we can say are wins. The ones that are lighter are losses, right? So it's 50-50 basically. That's what is here. Half of the trades are wins, half of them are losses. And if you look at the numbers of these, the average gain, these would represent these little blue dots would represent an average gain of 12.5%. The losses would be 6.25%, which is just 2 to 1. Is 124 of them here. So it's 124 trades, right? 50% profitable. Had you put all these trades together, whatever time frame, whether it's a year, however long it takes you, and you use 25% positions of 25% position, 25% exposure. So you were never more than 25% invested at any one time. Your exposure was always 25%, 75% cash all the time. And each position was 25%. If you had, these are the trades that you had traded, you would be up about 100%, 96.5%. That's what this turns into. Now, let's look at this example. This example is just saying that if you found 4 trades that met the criteria, you'd buy the 4 trades, as opposed to only 1 trade and then waiting until you get out of that trade and going into another one at 25%. So the first set is just 1 trade, 25% position, 25% exposure, 75% cash. And now you get out of that trade, you move to the next trade, right? That gives you the 96.5%. Okay, in this particular example here, we're using the same 25% positions, but we're going to 100% exposure, all right? Same number of trades though, 124 trades, 50% profitable, same average gain, same average loss. What would that total return be? The real question is, would it be more? Would it be less? Okay, you're 100% exposure versus 25% exposure. You obviously have an edge. You're a 2 to 1 trader and you're 50% profitable. So the answer is that the number is exactly the same. There's no difference. The only difference is that it might take you longer, all right? Because in this first example, you may have to wait to get into that next trade, and maybe there was 3 or 4 other trades that would have been offered to you. So yes, if there's a cluster of stocks all setting up, you are going to miss some names. There's no doubt about that. However, just looking at the math behind it, okay, there's no benefit. The bottom line is that in order to get to that 96.5% profit, you've got to do 124 trades with these numbers. However you do them. If you do them all at once, basically, you look at it this way. You drive from New York to California. It takes you the same amount of gas if you drive straight through or if you stop along the way and you stop and go. It's going to take basically the same amount of gas, right? It's the same thing here. It's going to take you 124 trades, whether you trade them 4 at a time or you trade them 1 at a time. Now, the question is, how long is it going to take you to trade 124 trades? How long is it going to take you if you trade them 1 by 1 versus clustering and moving to 100% exposure? That's a whole different discussion. But the math behind it, okay, is again, distribution. Looking at a distribution curve, your trading is going to distribute over a distribution curve. It's all going to come down to your average gain, average loss, and batting average. That's the bottom line. All right, and your position sizing, and that's gonna tell you everything. So don't be in such a hurry to get fully invested and think that you're missing the boat, because as long as you get those trades off, you're going to get that return. Now, this brings us to opportunity costs. So again, to be able to do this type of trading and be able to have do 100, 200 trades maybe in a year or in a 6-month period and get that type of big return and be able to roll these names over to be able to, maybe be in 75% cash and only have 25% invested at one time and still get 100% return. Again, looking at opportunity cost, are there more opportunities to trade a stock that goes up 5 or 10% versus a stock that goes up 20% or 50% or 100%? The answer is 100% gain is going to be a lot harder to come by, and it's going to take a lot more time, right? Almost every stock moves 10%, right? So if you are swing trading, and this is where I made the change over the years. In the beginning, when I first started trading, you couldn't trade short term. You couldn't move in and out of stocks and make. You couldn't be a swing trader because the commissions, first of all, were astronomical, $200-300 per trade. The spreads were super wide. You and I had a small account, so I had to get a double in a stock sometimes just to make a few dollars. So we were looking for doubles and triples, as opposed to now, I'm trading 10, 15, 20%, sometimes, a 40 or 50% gain on a stock is a big move for me now. Now I've had some bigger moves too, some triple digit moves on a lot of names, but the majority are going to be the swing trades. And you can get to the same number whether you have 175% winner, 320% winners, 6 10% winners, or 12 5% winners. The question is, which one of those is easier, right? Obviously, a 5% winner is easier to find than a 10. A 10 is easier than a 20, and a 20 is easier than a 75. So again, don't get hung up in thinking that you've got to get this big giant move, which is nice to have, but you can get to that same number with the smaller profit trades. And that what that does is that opens up your your risk profile to a much less risky situation. Because first of all, if you can trade this type of trading right here on page 421, you can trade where you don't have to be fully invested, and you can keep a lot of cash and not have your exposure too high because you're turning trades over so quickly, right? You also are not going to go through drawdowns as big, because to have a stock that goes up hundreds of percent, you're going to go through some pretty big drawdowns. You're going to have, and especially if it's a really big move like an Amazon. You go back, look at Amazon, and you may in hindsight say, well, it was worth it. Yeah, in hindsight, but who knows when a stock goes down to 50 or 60, 70, 80%, and it's going to come back, right? You don't know that. So you can't afford to let stocks go down that much, but you would have to allow a stock to go down probably at least 50% if you're going to make a giant move like you've seen in Amazon or a Cisco back in the day, or a Netflix. These stocks are going to have and will always have big drawdowns. So, and you've got to stay in them for extended periods of time. So you're not able to control your risk as well. So again, this is just looking at opportunity costs. I just want to, finish up this section with letting you know that I made the biggest returns when I started swing trading, and I got away from trying to get the big giant move, even though we look at super performance stocks, because I'm trying to find stocks that make big moves and sometimes trade them a bunch of times. Sometimes I trade one name 4, 5, 6 times in a move, and the stock goes up 500%, 1,000%. And during that time, one trades 30%, another trades 50, another trade is 20, maybe one is a loss, and I get a double on one of them. That sort of explains what I did with Yahoo. I traded Yahoo. The first time I traded Yahoo, I made about 30, 35%. The second time I made a double in 3 months. Then I made a few more trades. One was like 60%. Another one was 20%. When you compounded it all together, I had a pretty good lick on that stock, and that stock went up 8,000%. Now you might say, well, you could have held it and made 8,000%. Yeah, and I didn't know that. That's all in hindsight, of course. But I have much more control over what I'm going to generate and how consistent I'm going to be when I move down this ladder and I'm looking for those smaller profits. Now, of course, 5% profits you're looking at, that's more of a day trading type situation. That's not realistic. 10 to 20 is realistic. That your risk will pay for that, or I should say that will pay for your risk. So anyway, I'm going to end this and go over just what we've covered throughout this workshop. And we're still going to talk a little bit more here about post analysis when I come back. And of course, we have live trading and some more things that I want to go over here. But let's just recap real quick here. What we covered so far is we covered categories. We talked about the various categories and how you have the market leader, you have the top competitor, the institutional favorite, and the turnaround situation. Then you also have commodity plays, right, and cyclicals. But I'm mainly staying in those four categories, and I really want to be in those leading stocks, right? I want to be in the market leaders and the top competitors. That's where I'm really looking to put the bulk of my capital. Then we looked at valuation, and basically what we came up with valuation was valuation doesn't really matter. Maybe to a value buyer it does, but when you're in high growth stocks or stocks that are trading on the promise of a new blockbuster drug, the valuation, you really can't value those stocks because the growth is too fast, and the PE will take care of itself if things work out for that company. So the valuation you want, if you're going to use the PE, we talked about a few ways when the PE expands a multiple several times. You can look at that with base counting, get an idea if maybe the stock has made a big run. If the PE is exceptionally low, the market trading at 20 times earnings and the PE's 5, that's a warning. That's a warning sign. That's not a value. That's a warning sign. The other thing too is I like to see the PE above the market. I want to see a pretty good PE relative to the market because I want to be in that merchandise I want to be in the Ferraris, not the Hyundais. So now we talked about the trend. The trend is your friend. That's the saying, right? There's a reason that's a saying, because the trend is your friend. And we talked about stage 2, the stage 2 uptrend, making sure you're in a confirmed stage 2 uptrend. Why do we want to be in a stage 2 uptrend? Well, the first reason is because we want to be in the 99% club, not the 1% club. 99% of the biggest winners in stock history, they made their big move in stage 2 uptrend. Before they made the big move, they were already in a stage 2 uptrend. So if you're going to find the next Amazon, the next Netflix, the next stock that doubles quickly out of a power play, there's a 99% probability it's going to be in a stage 2 uptrend. There's only a 1% chance that a stock in a downtrend is going to make that type of move. So probabilities are in your favor. That's what this is all about, putting all the probabilities, stacking probabilities in your favor. Then fundamentals. Fundamentals, we looked at a lot of different ways to look at earnings, sales, and margins, but I only looked at 3 things: earnings, sales, and margins. That's really all I'm really concerned with. I'm not looking at book value and all these esoteric calculations. All you need for growth stocks is to look at earnings, sales, and margins. And I gave you a bunch of ways to slice and dice those numbers and to take a look at a breakout year, quarterly acceleration versus the growth rate, a whole bunch of different ways to look at code 33s. You're getting acceleration in your margins, your sales, and your earnings. So you've got all the tools. You got all the tools you need to look at fundamentals. The main thing is don't get too tricky and start trying to get good at analyzing those 3 items, and you won't need to look at anything else. Then we looked a lot at price and volume. Right? Price and volume was the bulk of this workshop, where we looked at a lot of chart patterns and talked about everything from VCP patterns and volatility contraction, of course, and cheat areas and low cheats and handles and base breakouts and pivot points and squats and reversal recoveries and I can't even remember what else, but lots of things that we went over, right? Entry points, looking at the entry points, the exit points, selling into strength, counting the number of days that the stock is up, all these little techniques that can help you nail down your profits. Risk management, we had a very heavy session on risk management, and then of course position sizing. So these are the things we covered. And when I come back, we're going to cover post-analysis, a little trick or a little way that I do post-analysis and look at my trades, and then use a quantitative approach to get some information from there that's valuable that I can use going forward. And I'll show you how to do that in just a little bit. So we're going to take a break now, and again, I'll let your brain cool off a bit, and we'll be back.
All right, guys, that is the third part of risk management. I know that's a lot. I see a lot of comments. I think from the comments, you can see whenever somebody asks me, what's the difference between reading Mark's books and attending the workshop? I think today will give you just a sampling of It's night and day, night and day. With that said, let's take a 10-minute break here. Let your brains absorb that. Go do some sit-ups, get the blood pumping, go get some food, get a drink, get a bathroom break, and then we'll come back for the last section of the day, which is going to be post-analysis and Mark's wrap-up. That will be also just over 45 minutes. So let's take about 10 minutes here. We'll come back and get started with that.